Welcome to Chart of the Day. I'm Robert Folsom. Inverted yield curve. What it is, why it matters. This chart of the day describes the inverted yield curve. It's an excerpt from a just posted video for subscribers by Pro Services interest rate analyst Jordan Kotick. I think you'll learn a lot. Here's Jordan.
Now let's talk about the real story on Friday, and that was, of course, the yield curve. So when we go to the chart gallery, just a couple of introductory notes on the curve. I'm going to spend a few minutes on it this week. Clearly, some of the economic reports in the U.S. have been weaker. The European situation is clearly deteriorating, but what you had was 10-year yields dipping below 3-month bills on Friday, which gave the market a collective freak out. Now you have to understand when it comes to the curve, bear with me for just a second because I think this is important. You can have an imbalance in some point, you can have issuance at some point of the curve that can distort the curve. So any specific point in the curve you can't get too wound up about. It's the entire curve, it's the process of the curve. And when you look at it, the process of inversion started last December. Here was 2s, 5s, and I did a video for ETV on this in December. If you have any questions on it, as always, just shoot me an email. But here was the inversion in the month of December. So the inversion started with 2s versus 5. This is where it all began. So that was December. Now we look to what happened on Friday, 3-month versus 10s. And I put this little red line just to emphasize it here. Here's the inversion you had on Friday. So this was the next part of the inversion process, which gave the market a reason to panic. And as you can see, when you go back 3-month 10s, when you've had inversions, you've had recessions. Inversion, recession, inversion, recession. Now we have inversions. Now remember, there is quite a lag here between an inversion and a recession. However, the more the rest of the curve inverts, the greater the high chance of a recession. And if you look at it here, what I did is I put 1 year versus 10 years and 3-month versus 10 years, just to show it to you in terms of perspective, taking it back to the 1950s. So when you've had inversion, the gray is recession. Now in the 60s you had it here, you had to have a couple of inversions before a recession, but the bottom line is, since the 60s you haven't had an inversion that hasn't led to a recession. So now part of this is down here. We've had a bit of an inversion, again, symptomatic of a recession coming over the next year or two. We'll watch the stock market accordingly. And the next one to watch, of course, is going to be 2s, 10s. This is the next panic, and this is the real benchmark for a lot of people. We're around 10 basis points between 2s, 10s, but back again since the 80s, you can see inversion below here, recession, inversion, recession. It's pretty clear, etc., etc., etc. What ends this, what tends to happen is you have an inversion, you have a recession, and the Fed goes from a tightening cycle to an easing cycle. And the easing cycle, the front end outperforms and the curve steepens. So if the curve starts to steepen, which is going higher, that would be the bond market's way of saying the Fed is going to an easing cycle, and it certainly seemed to be that way this week with the Fed taking itself out for the next year. Just a quick side note, look, there's a lot to know about the yield curve basics. There's 4 basic types of a yield curve. There's the normal upward sloping, there's the inverted downward sloping, there's the flat curve, there's the humped curve. This is the inverted curve that everybody is talking about. Those of you who have done your CFA know everything from pure expectation theory to liquid preference theory, all the CFA stuff. As an ex-bond trader, I'm very familiar with all this as well. It's very important. There's a lot to the yield curve, but the takeaway for this week is to please remember the yield curve is a process, not an event, and that process started in December. The clock is ticking from the bond market's perspective for a recession in the next year or two, and what we saw on Friday is only symptomatic of more to come, with a focus on 2s, 10s as the next major shoe to drop. So let's stay bullish in the new week. As always, have a great weekend. Good luck trading, and we'll speak to everybody next week.
To see Jordan's full video, including his Elliott Wave forecasts for the Treasuries market, sign up for free week via the fast steps below.